Consumer confidence is at its highest level in 14 years. So what does that mean? It means that it's time to lighten up on stocks and build up your cash reserves. Yes, you heard that right. The stock market tends to perform worse when consumer confidence is high, and that was the conclusion reached after analyzing the S&P 500's correlation to the University of Michigan's Consumer Sentiment Index, which last Friday reached its highest level since 2004. The study by Mark Hulbert of the Hulbert Financial Digest compared each month's index reading with how the stock market performed over the subsequent month, quarter, year, and 2-year period. It also measures how the S&P 500 reacts to big jumps or declines in the index. The same study was also made for the Conference Board's Consumer Confidence Index. So let's take a look. The findings were that consumer confidence is a meaningful contrarian indicator in the stock market. Like other sentiment indicators, consumer confidence tends to rise and fall along with the stock market itself. Accordingly, consumers are most confident at market tops, just as they are most pessimistic at market bottoms. So it should be no surprise that consumer confidence measures behave in the same contrarian fashion as investment sentiment indicators. Of note is that the increase in the latest University of Michigan Consumer Sentiment Index came after the stock market's correction in late January and early February. It's relatively rare for consumer confidence and sentiment to rise when the stock market is falling, and suggests that many investors are stubbornly clinging to their bullishness, no matter how scary the market's volatility. That's a bad sign from a contrarian point of view. And the bottom line is be careful not to interpret the latest consumer sentiment levels as being bullish for the stock market. Far from being a reason for the bulls to celebrate, the latest consumer sentiment readings suggest that we could be close to a top. Let's go to the next chart. Another warning sign for the stock market are credit spreads. And according to Matt Maley of Miller Tabak, credit spreads are widening, and while this may not be a 5-alarm fire yet, it's an omen for the risk assets such as stocks. There's no doubt that credit spreads are starting to widen out a little bit in the last couple of weeks, especially in the past few days. That's usually a good leading indicator for a problem with risk assets. The market CDX North American Investment Grade Index has sharply increased in March, adding to gains seen earlier this year. The market index holds 125 investment grade North American entities with high liquidity that trade on the credit default swap market. When spreads widen out, banks are less willing to loan money, but more importantly, there is a huge amount of leverage in the system. Rates move higher, and especially if spreads widen out, people have to unwind some of that leverage. Credit spreads widen when the U.S. Treasury markets are favored over corporate bonds, typically in times of uncertainty or when economic conditions are expected to deteriorate. The spread measures the difference in yield between U.S. Treasury bonds and other debt securities of lesser quality, such as corporate bonds. Now, we may not be at levels seen in 2008, but widening credit spreads act as a leading indicator for asset prices and are a signal worthy of attention. And if they start to widen up further, it's going to present a problem for many risk assets, not just the stock market. The yield spread in bonds is telegraphing a similar shift in the market, and we've talked about this before, and it's called the flattening of the curve. And the yields on a 2-year to 10-year are compressing. The market's basically anticipating a slowdown in economic growth rather than expansion in economic growth. All of those factors should be a big warning sign to investors. The 2-year, 10-year spread was at 54 basis points earlier this week and has been in a steady decline since earlier this month. A compressing yield spread, or the flattening yield curve, usually suggests lower risk appetite among investors as they gravitate toward safe haven investments and assets such as shorter-term bonds. Let's go to the next chart. Tech stocks are also flashing warning signs to the stock market. In a measure, comparing riskier tech stocks to safer utilities is triggering memories of what happened just before the dot-com bubble about 18 years ago. Price performance between the two sectors has spread lately to a gap not quite as wide as during the dot-com bubble, but it's close. Using a measure called the Popular Planned Ratio, Jim Paulson, chief investment strategist at the Leathhold Group, sees danger signs growing for the bull market that began 9 years ago. Even though its magnitude is less dramatic, the character of the PP ratio in this bull market is amazingly similar to what occurred during the 1990s. The obsession with dot-com stocks in the late 1990s has been replaced with today's fascination with the FANG stocks. And the FANG stocks are Facebook, Amazon, Netflix, and Google. While the performance gap between the two sectors stayed flat during the early years of this bull run, it has expanded since 2016 and has surged in the past few months. While this does not suggest a massive collapse similar after the dot-com era, but it is another reminder that the character of the current bull market has changed. Utility shares are down about 5.5% year to date, while tech has been the market's best performer, up nearly 7%. Essentially, the sector has become a proxy for the greatest risk appetite. And Paulson has said that the ratio can continue to grow before it breaks, but not much higher and not much longer. So let's be cautious. And as I said earlier, let's continue to raise some capital, some cash that you can deploy when opportunities arise. So for today, that's ChewDog Charts. Thank you.